Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 20th, 2017 edition of Market Outlook. So, pretty decent week overall. We actually handled the rate rise by the Federal Reserve quite adroitly, and let's take a look at some of the details. First of all, you can see the S&P 500, it's showing down 0.14% for the week. But in actuality, since we went ex-dividends, dividends were paid and removed from this particular index, you were probably up fractionally for the week, which is probably about 3.5% or so on the week. So pretty good shrug off of what could have been perceived as a real hit and a flight out of stocks, but markets responded well. And in fact, if you look at accumulation versus distribution, we know that the market had been under some sort of pressure, and it's certainly in a neutral territory. So in terms of overall volume, I give it a neutral to a positive, and overall can't argue with trend, direction, or the net results for the week. That's a positive as well. Okay, let's take a look at some of the details, because that's definitely a little bit more interesting and possibly revealing. So first of all, what did occur is financials, as you can see, turns out to be the worst, one of the worst performers for the week, as well as transportation. Now, prior to this week, and certainly over the last several months since the election, transportation, semiconductors, and financials were the strongest sectors. And so yet once again, and with transportation going into a warning phase. So you got some deterioration here on the leading sectors. And so what you want to really find out is who's going to pick up the steam. Otherwise, leading sectors fall and the other parts not doing well, you've got an issue. And it could foretell a bit early though a potential top forming in the market. Now, one positive sign is semiconductors were up 1.4% on the week, and they were and continue to be a leading play up in here, right? As you can see, up 1.4%. So net, you got more things sort of deteriorating in the leadership area. So I give that a slight negative. However, real estate definitely picked up this week as well, which makes sense that the nervousness about a rate rise has now been alleviated. And in fact, the Fed is a bit dovish. So really interest-sensitive instruments all did well. Real estate and utilities did okay, up 0.5%, still outperforming the S&P 500. But there's several other things I'd like to take a look at. Let's point out in terms of the Fed raising rates, what really came out and was very clear that the nervousness and the anticipation has now been alleviated, and things like gold miners, copper, metals in general, all did extremely well this week. And you can see metals here up 3.7%, copper up 3.7%, gold miners up 4.3%. So really nice move there in these commodities and interest rate type sensitivity plays. Okay. So there you have it. So the interesting reaction was that the Fed was a bit dovish on the rise, and that has led support to the market and commodity type exposure. Okay, let's take a look at some of the market internals, and that'll complete the picture. So last week we did note that the market could be oversold on a short-term basis, because as you can see, we were trading down here. So we're looking at the McClellan oscillator. That was the most oversold it's been in quite some time. 10-day advanced declines really got hit hard. And again, you can see up-down volume also at really low levels. And we ended up with a fairly decent start of a correction here, at least on a shorter term basis. So the S&P still looking pretty good. That 235.50 that I pointed out last week held. That was a good area or a good level to certainly watch for. We never got close. Market, even though it tested and traded under the 10-day moving average, really held support, which we identified as back at that 235.50 level, even under 235, and that continues to be the case. So forgetting about all else, a key level on the charts in terms of support is the same level that we mentioned last week in this report at around 235 to 235.50. Okay, so overall, I'd look at the market internals as the momentum has definitely moved from oversold to moving in a positive direction. I look at that as a positive. Overall momentum, the picture here in the markets in general, look on a momentum basis positive. Okay, let's take a look at the NASDAQ composite. And in fact, I think we have been pointing out that it's actually stronger than the S&P, was less as oversold, especially in the up-down volume level. So we moved above what I would call the midpoint here. Our McClellan on the NASDAQ composite actually flipped positive and above the midpoint, dragging a little bit on the advanced declines. So net, I'm looking at the overall picture and the pause here, right? A couple-day pause right at all-time new highs. This is, the index that's on fire. Can only look at that as an overall positive scenario. And again, those lows there, certainly under around 5,800 in the composite would be a critical swing point. I'd be nervous and look for a much deeper correction in the markets if we breached those levels. Okay, so now let's take a look at the next chart here. This is something that I had pointed out last week that was a bit more of a concern, and this was the new high-low ratio. And as you can see, we definitely are in a warning. So in this case, a warning to a sell signal. This is definitely looking as true deterioration here. I'm going to definitely make new highs, new lows, and this particular indicator, both in the S&P. This is the S&P, right? You can see this breakdown beneath the 70 level, and after being as strong as it was, it's interesting that this compression zone, that this has occurred as opposed to strength that sort of occurred in this area before the breakout. So net, you can see rising strength over here, lowering strength. So there's a real divergence. Let's take a look and see if the NASDAQ 100 is acting in a similar fashion. And it is as well. So even though technically this is the strongest index, you can see new highs this week, flagging down a little bit, but certainly closed over the 10-day moving average. But in this particular case, you can see that this is definitely a negative. So we're going to watch out and make sure that we keep our stops really, really tight. And I would be using last week's lows or just a bit under that as your critical swing point. That would also take out the 10-day moving average and this compression zone here. So that is how I would look at NASDAQ as where critical support is. All right, let's now take a look at volatility. Volatility is telling you a different picture than what we just looked at. You've got sort of perfection. You're at a low level. You're not at an extreme versus the Bollinger Band, and under the 50-day moving average, the 50's under the 200. The Bollinger is just sort of moving sideways. So you can say on an absolute basis, yes, there is some complacency, but there isn't sort of a capitulation high. So one of the things that we want to look for is a breakout above this moving average over here. This is your 200-day moving average. That's about 1357 on a cash basis. Don't forget, you can come back to this website and review it, but at the moment, you can see that we're not nearly trading above any of the moving averages. We're actually below them in dead middle of the Bollinger Band. That is an overall real positive picture in terms of sentiment. If we absolutely see excessive where we're trading to the lower Bollinger Band touchdown or really close and then moving back above, let's say, the 10 or the 50-day moving average, that would be a real cautionary sign and possibly tell us that the market has hit sort of blow-off stages. But looking at it right now, we certainly aren't there. Okay, let's take a look at our next chart. And next one is looking at the ratio between 1 and 3 month volatility, all the same. Okay, so in terms of reading, and so you're in the a real positive zone, right? But not excessively so, and we're certainly not starting to trade, underneath critical levels, which is 1.2% after being way overbought in terms of sentiment, and that has not happened either. So I give sentiment overall a positive reading. Okay. All right, well, we covered that. So I'm going to introduce a new chart to you. And this is part of a new release that's coming up. So it's a little bit of an advance, but it's one particular chart. This particular one is looking at the SPY versus utilities with a six month and basically a 4-week type moving average. So this is a chart of the ratio. And we've got the moving averages, like I had mentioned, over here, right? Here's a moving average, longer term of the ratio between the SPY and the utilities. When the ratio is moving above the moving averages and positive, right? So your red is above this blue line and also above the black. That is basically a 1 month moving average of the SPY versus utility. And so when this ratio is moving positive, it's telling you that the SPY is gaining. So anyway, going back to last July or June, you can see that we were in a really nice long, uptrend, and confirmed by the way these moving averages are moving up. You can see, really, since this point in here, our relationship between the SPY and the utilities was moving in favor of the SPY, crossing the moving average, and we haven't been under it for quite some time. And as you can see, we're sort of losing momentum and broke this long-term trend. So when the utilities gain on the SPY, right, and right now we're sort of neutral, right? If you look at it, we've been in this big uptrend. This is a shorter term moving average. We're starting to get a little bit of weakness in here. And that could portend that the utility stocks, which is a safety play, are going to outperform the S&P if we certainly break down right around these levels. Now, it's possible, certainly, that we can turn around, move above that black line, which would be a positive, and this key ratio, which is a really good indicator, would move back into more positive territory. At the moment, right, I'm giving this plus slash neutral. Because of this 6-month moving average still being intact, I'm looking for a breakdown, which to me would be a very, very early sign of a real breakdown in the market indices. So this key ratio, real important to watch. You got a really interesting trend line that has been broken, and now support at the 6-month or the longer term moving average, which is still holding in favor of the S&P. All right, so you can see we got an overall positive picture. There is signs of erosion, and we know the critical levels that we could be wrong at. And or in terms of if you're long, you definitely want to tighten up stops, exit, or be more aggressive if these things start to break the levels that I mentioned in terms of more type of short plays in the market. But this is definitely a time to be a little bit more cautious. Again, to me, this is really interesting to watch. Hasn't broken yet, but definitely is looking like it's under pressure. So let's watch the markets, stay frosty. Again, trend overall intact. Watch for the exits. That's it. Bye for now, and see you next week.